Hello, everybody, and welcome to On the Move presented by Momentum Multifamily. I'm your host, Brendan Gardner, and today we're here with Brent Guldahl to talk about insurance in the multifamily space. And with that, Brent is a commercial insurance broker with Commercial Insurance Solutions. Welcome, Brent.
How you doing? I'm glad I'm here. Thanks for having me on. Looking forward to talking about the wonderful world of insurance.
Yeah,
Everybody's favorite topic.
the exciting world of insurance. It's important
Yes,
though.
it is very important.
So with that, would love to just hear about your background and how you got
Mhm.
into the insurance space in the first place.
Yeah, we kind of have a saying in the office that people that are in insurance just kind of somehow find their way into insurance, and maybe that's the case with a lot of industries, but that's kind of what happened to me. I got out of college, didn't really know what I wanted to do. Like most people, uh, didn't know where to start, didn't know had a business degree, didn't know what industry I wanted to be in. Um, my grandfather had a used car dealership in East Texas, and he said, "Hey, why don't you come work for me? Give it a year or two. Maybe I want to retire. You can take it over." And so I did that, and did that for about a year and a half. And he could see that industry was changing. Especially you see a lot in the small towns where whether it's a Walmart coming in or the mom and pop shops or the smaller businesses tend to kind of dry up. And at that time, the new car dealerships were getting into the used car business. You had I don't know if it was a CarMax, but those type of, so the margins were shrinking. And so, after about a year and a half, he just said, "Look, I think you can make a good living still, but you may want to get into insurance." One of his good friends is in insurance, and he said, he seems to enjoy it. Um, he does well. Why don't you meet with him? And I met with him, and uh, my grandfather said, "Look, work with me. I'll pay for your license. You can study here, get it done, and get a job somewhere." So I did that, and uh, my first job was with a large uh, personal lines agency that everybody knows. They're still around, big company. Interviewed, uh, left the interview, got the job, was going back to East Texas, and I have a family friend that's like a second dad to me, and he's in the insurance business. So I called him and said, "Hey, you won't believe this. I'm in the insurance business." It's like, "What are you doing?" Well, told him what I was doing. He says, "Okay, here's what you need to do. You need to hang up the phone from me, call them and quit, and come work for me." And so he happened to be he specialized in multifamily, and this was in 2000. So that's how I got into multifamily space. And
Wow.
he just said, it's kind of like probably, with these with multifamily investors, it's, you can, same thing. It's you can insure, the economies of scale, owning 250 unit apartment complex compared to two houses, right? So
Mhm.
he's like, "Look, you can insure a 200 unit apartment complex. It's the same. You're making the same money as if you were insuring 50 or 100 homes."
Yeah,
And so and it's just a different environment, different world of insurance. So that's how it started. And so I started with him, and just so happened he was a multifamily specialist. Back when there was when it was less specialized as it is now. And so that's all I've done since 20. That was the end of 2020. No, 2000. I'm sorry. So it's been almost 23 years, and it's all I've done. So we we went. He got bought out by one of the three or fourth largest insurance brokers in the world, within 3 or 4 months of me joining him. And so we went from a independent agency to a very corporate agency. Um, and then in 2003, with the guidance of another guy that I've known forever that was working there at the same company, we left and started Commercial Insurance Solutions in '03. So we're going on about to be 20 years in business. So
that's an exciting journey. Yeah, thanks for sharing that story. It's seems like you had some good people looking out for you. And I think it's particularly interesting too, because not a lot of people think about the fact that economies of scale translates to the insurance side too.
It does. It does. And to go a little further, on this journey is in 2013, we were looking to purchase other agencies to kind of expand outside of multifamily, whether it's benefits or whatever, and ended up the company approached us, so we want to buy y'all, actually buy you. And so it worked out perfect. We merged with them, and it's Acrisure. Acrisure is now, we were on the front end in 2013. We're the fastest growing agency in the world. And now we're in 17 countries, 45 states, 440 agency partners. And I think we're fourth in the US as size goes, and sixth, I think, worldwide.
That's amazing.
So for us, and they left us alone. So we do our thing. We're their multifamily platform. We're their largest property writer agency in the company as far as property volume goes, property coverage. And it's been a great partnership. We've got a lot of resources through them, and so it's just we're just continuing to grow, and it's been a great ride so far.
Yeah, that's awesome, and congratulations on that, by the way.
Well, thank you. Yeah.
Earlier in the conversation, you mentioned the markets within the used car realm made you take a shift into insurance, and now you're in insurance. And I think we all look at those markets and say, hey, it's a particularly tough market right now. Can you talk about the types of insurance relative to insuring multifamily properties and just what you're seeing in the market now?
Sure. Your main coverages are going to be your property coverage, which will be your physical damage to buildings, wind, hail, fire, car hitting a building, whatever it could be. And then you've got the general liability, right? That's lawsuits, trip and falls in the parking lot, which will provide defense cost and settlements if it ever gets to settlement. So those are the two main coverages. You've got some other ancillary stuff that you may need, like flood if you're in a flood zone, or if you're not in a flood zone. But those are the two main coverages. And so, as you mentioned, the insurance market right now is very tough. We're in a very hard market. Owners in the multifamily space, they know that, and it's been last year was 2022 was really tough as far as renewals go, is increases in renewals and restrictions in coverage, and that's been ongoing for probably 3 years now. Some of the things we're seeing on the property side of things are, last year was kind of the double whammy. We can get more into this later, but you had rate increases, and on top of that, those were anywhere from 15 to 40%. And on top of that, insurance companies were increasing their what they call insurance to value, which are the minimums they'll insure the buildings for. So, a couple of years ago, we were insuring buildings at $75 a square foot. We still had some at 75 square foot. Those are now minimum more like 100. So if you were at 75, 80 a square foot, in 2021, when you renewed in 2022, you got you were seeing say 30% increase in rate, and you were getting a 25, 30%, 40% increase in valuations, which increased premium. So overall, the increases were pretty big last year. At the same time, deductibles were going up, were increased, and then companies were restricting coverage. And so it was a tough year. I think, going forward, I think we're still going to see the valuations go up. They're going to, we've got, we're insuring stuff at 100 a square foot, but, I've got a client that had a building burned down, and just a kind of a plain Jane building, Central Texas. It's $140 a square foot to rebuild it. So insurance companies are saying, we really need to get closer to that $140 a square foot mark. So we'll see those go up, and we'll see rates go up again this year, for reasons we can get into in a little bit. on the liability side, probably doesn't get talked about enough in the market, but it's as hard as the property coverage. We're seeing increases in frequency and severity of claims. We're in the society we live in. It just seems like everybody's ready to blame somebody else for tripping in a parking lot, or you walk over the same curb every day for 2 years, and one day you trip on it and hurt your knee. Well, of course, that's the owner's fault, right? And so we're seeing a lot more of those claims, and likewise, rates are going up. Number of carriers are diminishing, and the coverage they're restricting. Carriers trying to restrict coverages to help absorb some of the losses.
Yeah, yeah. Thank you for that explanation. And so, as we think about this too, like naturally, insurance is something that's cyclical. You mentioned the term hard market. Can you talk about hard market versus soft market and kind of the cyclical nature of insurance, I guess?
Sure. Yeah. So it is cyclical. Typically, we've seen it for forever. It's you'll have 3 or 4 years of increased rates, and then they get to a level where companies think, okay, well, we can, they want to jump in and they can make money, and then they start undercutting, and then it's a very simple analogy, but then you get 3 or 4 years of low rates, they go down and bottom out, and then they and then it's almost like the insurance companies go, whoa, why are we writing stuff so low? I mean, we can get more for this. And then the rates start going up. But again, there's a lot more to it. But yeah, so every I'd say 3 or 4 or 5 years, it goes up and down. And so this market we're in now is, I think it's going to be an extended hard market where it's going to be another few years before rates could start trending down. And we're at a mark now where it's tougher than it's ever been. So, but yes, there will be a time where when it is, I don't know, but that rates will start trending back down. And 5-6 years ago, we were almost at kind of an all-time low. And so we usually don't see these extremes like this, but yeah, it's a cyclical marketplace.
Yeah, and despite the extremes, typically you see the good owners be able to invest in properties and make money for themselves or their investors, no matter what the conditions are. Can you talk through maybe any advice or tips that you have for multifamily owners and investors to help navigate the insurance area?
Sure. I think one of the questions I always get is, what can I do, right? And so the simple answer is don't have claims. I know but there's really nothing. One of the things you can do, and there's nothing you can really do that says, hey, you do this, you can save 20% on your insurance. If you're around the coast and your roof's 15 years old, if you replace your roof, then you could get better rates. But if your roof's in great shape, are you going to do that? Same way if what I tell my clients is, if you can limit your claims, you can at least stay on that lower tier of rates. Because especially right now in the hard market, claims are underwritten a lot tougher than they are when the market's soft. And so, and there's things to do. I think one of the biggest risk management things you can do is you've probably seen the fire canisters, the stovetop canisters that go over the stoves.
Yep.
I get that question. It's like, hey, what can I do? And I said, that's what you need to do. If you put it in your budget, because we see it work. We have a lot of clients that have them now, and they put out the fire. So, they're $35-$40 a unit, and they last 6 years, I think now. But putting out one kitchen fire can save you. I mean, it makes a big difference. And so, being more conscious of your property when you're, we tell clients to, again, that's what I think's the best bang for your buck are the canisters. Absolutely. But then, on an everyday basis, having, being proactive in claims in as far as, I'm sorry, inspections and taking care of your property. So it's, managers, whether it's weekly, at least monthly, walking the grounds, identifying, hey, there's a pothole over here that we need to get filled up, checking the stairs, and having a checklist like, okay, we've checked the stairs, they seem, check, we've checked the parking lot, we've checked for fire extinguishers in the laundry room, and then, every 3 months doing interior inspections when you're checking batteries and smoke detectors, just kind of looking around and seeing, hey, do these people have candles they're not supposed to have, but, just having a proactive approach to what's going on around the property and a lot of people don't know. So that's our job. Part of my job as a risk manager too, is to inform them on like, hey, here's what you look for. And I do that, and I'd be happy to talk to anybody about it. But, when you're walking the property, here's the things you need to check out. One of them's lighting. If there's a robbery or some kind of assault in the parking lot and it's after, the sun's down, the first thing the attorneys are going to say is there wasn't adequate lighting. So, at least once a month, having a maintenance guy or somebody checking the lighting at night to make sure there's no trees covering it, make sure bulbs are still in. And so those are the things you can do. There's some claims that you can't prevent, but those are things you can do that the clients that do that seem to have much lower claim frequency than the ones that don't.
Yeah, I think those are particularly creative tips or ways that folks can take care of their properties, and that's great advice. And so when you think about that too, are there other things that people can do, or I guess I should say variables that affect the rates on a property, whether it's property type or otherwise?
Yes. So I'd say, when you're looking at various rates, differences in rates, you've probably got three different things that are looked at. One, right now, number one is probably proximity to the coast. Two would be, right now would probably be age of the property, or losses, and then age of the property. It's hard to put them in order, but yeah. So the proximity to the coast, age of the buildings, and the loss history. So those are the three main factors that contribute to the various varying in rates. And there's even more we can go into. When the market's soft, there's more play. There's more, and there's reasons why it's soft. Maybe the market's better. There, when the market's soft, there's the owner has more negotiating power. You got more companies wanting to insure the properties, and you got more companies that are going, yeah, I see you had a claim, but it's okay. Apartments are a big risk reward in the insurance industry because they're a big premium, but they're known to have claims. And so a lot of the companies, they take the chance, and they're, but it's a big risk reward industry. But yeah, so those are the three main things. But then getting deeper into it, number of buildings is a big thing. It's good or bad. And we can talk about like the difference, if you want to talk about like a garden, so we can talk about garden style and maybe like a podium or wrap type deal. This goes into it, but we've got companies that say, okay, they don't want, so let's go to a podium style deal. The advantages are there's a small roof exposure, and so you don't have a hailstorm. It's not gonna be that large. Whereas garden style, that's the biggest issue. You've got 15, 20 buildings, and you've got all this roof exposure. But on the flip side, on the podium style deal, you may have a $40 million project, all of it in one building. And so all the limits in one building. So the insurance company looks at it and goes, yeah, but if there's, more than likely they're sprinklered, but if there's a freeze, if there's a fire, if there's a tornado, you're more, you're going to probably cause more damage because you could lose a whole building. Compared to garden style, the advantage is you may have 15 $2 million buildings, and if you have a fire in one, more than likely you're limited to $2 million, right? So when you're looking at other factors other than age, proximity to coast, and loss history, right now companies are really digging into underwriting them. For instance, we've got a company that if they can't insure anything over like a $3.5 million building, and so you look at it and you go, hey, okay, this is right up their alley. They'll do this one. Well, you dig into it and start figuring out the building sizes, and you go, okay, well, this is a $5 million building. One building's $5 million. They're out.
Yeah.
And they're even getting to the point where if they're too close, you have $2 million buildings, but they're right next to each other, close enough, they consider it one. So there's a lot of factors that go into it. But yeah, those are probably the three main factors as far as what can really affect the premium and rates to a degree.
Yeah, and as we talk about all the factors now, I guess what are you seeing for rates across the Texas metros now?
Yeah, I'll say, well, I'll tell you, going kind of backing up a little bit, explaining why the rates are up. And then we'll get into the rates, but so property side, we've just had there's been a lot of big cat claims, and so more so than in the past. So I think this is year 5 maybe in a row that there's been 17 or more billion-dollar events, separate events in the US. So 17 different events that resulted in $1 billion worth of insured damage.
Wow.
Which it's like 5 years in a row. So it's a question I get. Clients say, hey, why are my rates up so high? And so let's go into Ian, Hurricane Ian. People, I know, people in Texas go, hey, well, we haven't been hit by a hurricane in how many years in Houston? Well, that's true, but the same companies insuring Houston's insuring Florida, Georgia, Alabama, South Carolina. And so like Hurricane Ian, projected estimates, loss estimates are around $50 to $60 billion in insured losses. And that's not just apartments, obviously, but just overall. And so these are the size of some of these claims that these companies are seeing. And we've got the winter storm, end of 2022 that, Buffalo and up in the Northeast, that's going to be very large. We got the California stuff going on with the system going through California. And then globally, every company's kind of interconnected with reinsurance, and that's a different topic we won't get into, but reinsurance is a global, they're global companies. And so, there's the stuff in, I think, Canada's had a lot of flooding. Australia's had a lot of cyclones, even the war in Ukraine. The reinsurance companies are having to pay on all those claims. And so, and I don't know if it's, industry people say global warming, scientists say global warming, and they're, we can debate that, but it does appear in the last 5 or 10 years that there's a higher frequency of cat events, weather events, and they're larger than they have been in the past. And that's a combination of, we're just building out so much now. There's so much more exposure. Construction costs are a lot higher, right? But at the same time, the events are bigger too. So that's the main reason, in a nutshell, is why we're in this hard market and what's going on in the marketplace. Liability side, it's more similar type situation. Frequencies are up, severity's up. Reinsurance is involved. Reinsurance is basically, keeping it simple, is, a company buys insurance to protect itself. So they may, it could be, hey, we, we're going to show this building for $10 million, a simple example, but we're going to buy reinsurance. So anything over $2 million, then they either pay it or that we'll split it with the reinsurance company. So that's where reinsurance comes in. And reinsurance is in, all different industries. So the liability side, there's, pharmaceuticals there's a lot of claims on the pharmaceutical side. These mass, whether it's shootings or whatever it is, there's lawsuits involved. It's, the condo collapse in Florida, that was I think a $50 million, $100 million settlement. So that's kind of a background of why we're seeing these increases. But to get back to your question on rates. So, I'd say let's go in Texas. The best rates are found in San Antonio, Austin. The hail risk is smaller there, still there, but it's smaller once you get north of like Waco North. The hail risk is increased. So, Dallas rates are, so, I hate doing per building. when I say what rates are, no one will really understand unless you're in the insurance business. Most owners and multifamily people will go off per building. But it can vary a lot depending on the location. But I'd say, San Antonio, Austin, you're still looking at, I did a renewal last month that was, 700, 650 to 800 a unit for, 15 locations. So it depends on the location. Dallas Fort Worth, probably pushing that 800, 750 to $1,000 a unit. The difference in the two markets is a little bit on pricing in Dallas, but it's deductibles. In Dallas, you're going to get a higher wind deductible. Right now, they're right around 5% of the insurable value, which is a large number. And then San Antonio, Austin, about 3%. So that's the big difference there. A little bit of rates better in Austin, San Antonio. Houston, coastal stuff is the hardest to do right now. On the low end, you're probably looking at 1,100 a unit. And I renewed one end of October that was $2,500 a unit around the Beaumont area. And it had a fire or so, but 2 in the last 6 or 7 years. But yeah, so it varies a lot. Right now, the toughest region to insure is coastal. There's just nobody that wants to do the coastal stuff. And I mean, we're literally talking, if you got a $40 million project, you're going to have to get 4 or 5 carriers, probably, at least 3 or 4 to even get to the $40 million limit. And so the rates, the premium just adds up.
Yeah, it sounds like there's just the mass trickle down, both from reinsurance, but what's happening in the macro, and then down to the insurance company, and then down to the ownership of the property naturally. And you talked through the cost per unit. Just out of curiosity, with larger volumes, is there typically a break in cost per unit, or is it, hey, this is our risk and this is the cost no matter what, because we're going to have to pay out on this?
There's a break, yes. So, and I say depends, like everything. Typically when you get to that, you can maybe see a first break around, 800,000 units. And then the more units you get, the better break you get, economies of scale in the pricing. Today though, it's, if you have 10,000 units, right? Let's say you have 10,000 units, they're all in Houston. You're going to get a break, but it's still not going to, the insurance companies are look at it now and go, man, you got a lot of exposure sitting right here in Houston. Do we want to even be a part of this, right? So ideally, when you're talking about economy, getting a break on rates, the perfect world, you'd have, 5,000-10,000 units, some Houston, some Waco, some North Carolina, so, spread out to where there's not the spread of risk is a lot greater. So you do get breaks, but if you have a large concentration in Dallas, for instance, or Houston, for instance, your break's not as big as it was 5 years ago. It's getting tougher to do. The larger policies are getting tougher to do. I've got clients that may have 5 or 6 locations in Dallas, and we've had to break them up and do 5 or 6 different policies, each one on their own policy, because it made more sense than putting them all in one.
That's interesting.
Place them with different carriers, just because the one company's, it's like, man, I don't want to have that roof exposure for this one client, one one group that's 6 garden style apartments in DFW that are 10 miles from each other.
Right.
So again, when the market's soft 5 years ago, I had a 15,000 unit management company in Dallas that were all Dallas Fort Worth, and there was no problem getting it done, and they had a much better, 25% better rate than if the owner went and did it on their own. So yes, you do get an advantage. It's just not as much as you used to.
Yeah.
And hopefully that'll change once the market goes back down.
Yeah, and I can imagine if I'm an owner too, and I got 5 or 6 policies now, like those annual renewals might take some time.
Yes. Yeah, it does. Yeah. The good thing is they're on the same date. So, it's what we do as an agency is, you may have 5 renewals, but when it comes to renew next year, we're going to market it all together separately. And so, the issue comes is when you have 5 properties, 5 different expiration dates, and people tell me they don't like to deal with insurance, and so they want to deal with it once a year.
Yeah.
And you're dealing with insurance every 2 months, and so it's hard to keep up with for the insured. But yeah.
How far ahead should an individual, whether an owner or insurance broker, be in terms of actually communicating and discussing the renewal policy?
Good question. I would say so. Probably 120 days out is a good time to start, and that's just discussing with your agent. Hopefully your agent is giving you some updates throughout the year, like, hey, here's what's going on in the market, and but 3 to 4 months out, I'd say 4 months out, kind of expectations, and if anything, hey, my question would be, hey, what have you done to the property? So our job is to, different than personal lines where you have a car and you come to me and I go, okay, it's 19, whatever, I put all the information in and it spits out a quote. These are all underwritten individually. So by an underwriter looking at it. So our job as an agent is to, hey, Brendan, what have you done this past year? Let's make sure, your roof age is correct. You got any capital improvements coming up? So my job is to, it's not a great example, put lipstick on a pig,
Yeah.
as they say, but to sell, to sell, and I call it a pig because, apartments, insurance companies, again, it's not their most favorite risk, right?
Yeah.
Because they're heavy claim volume, but my job is to sell the deal. So the more information I can gather from you and the more information I can provide the owner, like I said, those inspection reports, if I can tell the GL underwriter that, hey, Brendan's a very proactive guy, I'll go take pictures of your properties. And hey, look, here's what he's doing. He's walking the properties monthly. He's inside the units every 3 months. He's doing this, doing that. Compared to somebody else submitting the same thing and just here it is and not providing any of those details of what's going on, I'll get a better rate than they will. So that's our job is to, but yeah, meeting 4 months in advance to get all that information and develop a strategy and is the way to go about that. Yeah.
Yeah, and actually, you covered some of what I was thinking for my next question in terms of like I always like asking the different personas that we interview, just being in the industry, like what do you think separates great owners of properties, whether it's the good from the great or even what you might think about before you invest with someone? Like, what kind of things do you see?
Yeah. Of course, I see the whole spectrum. um, I think, as I said, the owners that are proactive, that are, I think, you've got owners that, like Momentum, multifamily, buy a property. At the end of the day, you do everything you can to increase the, revenue, increase the NOI. That's why you buy the deal. But you can do that by making the place a better place to live, and creating a better culture, getting rid of some of the bad apples, more community events that creates more of a, it feels like, family, or more like they they care about the property more because they know everybody. Upgrading the look of the buildings, just making it a better place to live, and creating a better environment for everybody. Give everybody, is proud of where they live, right? And then you got the other extreme where um, the owner's trying to maximize revenue, but their thoughts of doing that is very little upkeep, and increase the rents all they can without putting anything into the property. And you know, um, I think at the end of the day, obviously that approach, you just end up having you get the people like the Momentum folks. Everybody wants to live in those properties that have been updated, and there's a community there. No one wants to live on the properties that aren't getting maintained, and then those properties end up getting the bad apples that get kicked out of the other location. So I think looking at my clients is, proactive approach to everything, whether it's, insurance, taking care of the property, and yeah, that's the biggest thing. Yeah.
Awesome. Well, I know we're getting close to time. I found this conversation extremely interesting, learned quite a bit. Is there anything else that you'd like to plug or share with the audience?
Um, no, I would say that, if we're talking about new purchases, or we're talking about renewals, I mean, on renewals, yes, getting in front of your renewal with your agent is very important. As far as new purchases, I would tell everybody to really pay attention to insurance. Make that one of the top priorities, because if you're doing a performer, you're trying to figure out penciling in, does it work? I see it a lot where people come in and go, hey, all right, hey, I went under contract on this. Like, I didn't even know you did. Oh yeah, I'm under contract. I used $700 a unit for insurance, and we start going through it, and I'm like, that's going to be closer to $1,000 a unit. Well, that's not going to work. I got to have so with the market, and we used to could do that. Used to, you could give me a property and I can give you a rate within 5% just about every time within 15 minutes, right? So, but now really get with your agent and say, hey, look, before you even go under contract, because as I said, there's variables involved that could make it 1,000 a unit, especially along the coast. It could make it 2,500 a unit. And so I would make sure to discuss insurance with your agent, and try to get it's hard to get an accurate number, but as close as you can before you go under contract with it. And I think that's about it. It's a tough market, and even me, like I said, Hayden called me the other day about a deal, and I said, look, I need a day. I need to talk to, I know, I have a good idea what it's going to cost, but let me talk to a couple of underwriters, because there may be something about it that I'm not seeing that they see that could affect the rate. So
Right.
It's very important to make that a priority when you're looking at new deals today.
Yeah, proactivity comes back to the proactivity.
Proactivity. It's all about proactivity. Yeah, being proactive on your properties. It's a big thing. So,
well, this has been absolutely phenomenal. For our listeners that want to take advantage of Brent's information, we'll have that in the description below. And if you want to get involved in the community, please go to momentummultifamily.com, where you can learn more about these types of conversations and events that we put on. But thank you, everybody, for listening. And Brent, certainly thank you for the time.
Thank you, Brennan. Enjoyed it.